There is a crime scene sitting right in front of me, and the crime has not happened yet. I need you to sit with that sentence for a second, because it is not a metaphor. It is not a rhetorical hook. It is a precise, factual description of what is unfolding on this Saturday afternoon, March 28, 2026. While most of America has no idea, the criminals are not hiding, they are not gone. They are in boardrooms and clearinghouse war rooms right now, on a weekend, building the weapon they intend to deploy against you on Monday morning. Not against hedge funds, not against sovereign wealth funds, against you, the retail investor who had the nerve to buy silver on Friday and actually come out ahead. And I can promise you that Bloomberg will not say this, CNBC will not say this, and every financial media platform you trust will bury this story under sponsored content about crypto and AI stocks before the weekend is over. But I am going to say it, clearly on the record with a timestamp, so that when Monday comes and the system does exactly what I am about to tell you it will do, you cannot say nobody warned you. Silver closed the week at around $70.42. To understand why that number is dangerous to the institutions, you need to know where silver was just a few months ago. In January of 2026, silver hit a nominal all-time high of $121.67 per ounce, the highest price in the entire recorded history of silver as a traded commodity. And then, in a coordinated liquidation event that the Treasury Secretary publicly blamed on Chinese speculators, the price was crushed almost 50% in a matter of weeks, from $121 down to the low 60s. A 50% haircut on a commodity that has been in a verified supply deficit for 6 consecutive years. 6 years of demand exceeding supply, and they manufactured a 50% price decline. That is not a market functioning. That is a market being operated. And on Friday, the people on the other side of that operation started fighting back. Now let me tell you exactly what happened on Friday, because the financial media is going to spend this entire weekend scrubbing this story clean. Friday was a monthly options expiration on the COMEX. That means hundreds of thousands of options contracts on silver futures either expired worthless or converted into live futures positions. And here is the part that will not make the evening news. The call side of the options chain, the bullish contracts that profit when silver goes up, was absolutely loaded. The smart money, the physical accumulators, the Asian central banks, the sovereign wealth funds that have been systematically draining COMEX registered inventory for 2 straight years, they had positioned themselves precisely for this kind of move. When silver started rallying into expiration and the spot price punched through critical resistance levels Thursday night in the Asian session, the market makers were caught completely off guard. A gamma flip happened. And if you do not know what a gamma flip is, you need to understand it before Monday morning, because it is the exact mechanism that just turned Wall Street's playbook against itself. Gamma is a measurement of how fast an options dealer's hedge position changes as the price of the underlying asset moves. When a market maker sells you a call option on silver, they are required to hedge that position by buying silver futures. The amount of silver they need to buy shifts as the price moves, and the rate of that shift is gamma. When the price is far from the strike price of the option, gamma is low, and the dealer barely has to adjust. But as the price approaches the strike, gamma increases exponentially. The dealer has to buy more and more silver futures just to stay hedged. And when the price crosses the strike, the dealer flips short gamma, meaning every single tick higher in silver now forces them to buy more futures, which pushes the price higher, which forces them to buy even more futures. It is a self-reinforcing feedback loop, a doom loop, a liquidity cascade that accelerates until someone runs out of money or someone pulls the plug on the whole system. That is exactly what happened Friday. The options dealers, the market makers, the big banks that write the bulk of silver options on the COMEX, they got caught inside a gamma squeeze of historic proportions. They were forced to buy silver futures into the close, which pushed the price higher, which triggered more forced buying, which drained clearinghouse liquidity faster than it could be replenished. And now we arrive at this Saturday afternoon, and the numbers on the board are terrifying if you know how to read them. COMEX registered silver inventory sits at approximately 88 million ounces. That is a 32% decline from just 4 months ago when it was at 130 million. Total COMEX silver inventory, registered plus eligible, has cratered 31%, from 532 million ounces in October down to 366 million ounces today. The coverage ratio, which is the percentage of outstanding paper claims that can actually be satisfied with deliverable metal, sits at 13.5%. That is deep inside what the exchange itself classifies as stress territory. Paper leverage is at 7.4 times, meaning there are 7.4 paper claims chasing every single ounce of registered silver. And April 2026 First Notice Day is 2 business days away, with 1,981 contracts, representing 9.9 million ounces, still open. The clearinghouses do not have the silver. They do not have the dollars to go buy the silver. And they know, with mathematical certainty, that when Asian markets open Sunday night, the price is going to move higher. And when American retail investors log into their brokerage apps Monday morning and try to buy, that is when the lockout begins. Smash the like button right now if this channel has given you information that your brokerage, your financial advisor, and your newsfeed never would. 3 weeks ago, I started covering the COMEX inventory drain in real time. 3 weeks ago, the videos stopped surfacing in search results. Subscriber notifications started arriving 4 hours late, and live streams were getting demonetized within the first 90 seconds. Share this video. Send it to everyone you know who has money sitting in a digital account they cannot physically touch this weekend. Because what comes next could determine whether they walk into Monday prepared or blindsided. This playbook has been run before. It has been documented, perfected, and repeated across decades of institutional abuse targeting the retail investor. Let me give you 3 historical examples because the parallels to what is coming on Monday are so precise they would be almost academic if they were not so enraging. January 28, 2021, GameStop. Robinhood, the brokerage that branded itself as the great equalizer for the little guy, the democratizer of finance, removed the buy button on GME and AMC at the exact moment the short sellers were facing a margin catastrophe. Their stated reason was liquidity. The NSCC had issued a $3 billion margin call that Robinhood claimed it could not meet. So they did what every good corporate citizen apparently does when their clients are on the verge of generational wealth. They locked them out. You could sell. You could panic sell all day into the crash their restriction was causing, but you could not buy. Retail order flow on the buy side was zero, while institutions covered their shorts behind the curtain. Congressional hearings were held. Vlad Tenev delivered his best Silicon Valley apology tour and explained that the system made him do it. And then nothing happened. No one lost a license. No one faced criminal consequences. The DTCC quietly reduced that $3 billion margin call to $700 million after the buy button was already gone, which tells you everything you need to know about whether that original number was real, inflated, or deliberately engineered to trigger the restriction. The retail investors locked out during that window watched their positions fall 60, 70, 80% while refreshing an app that told them the market was experiencing technical difficulties. The Hunt Brothers, 1980. This is the original silver lockout, and if you do not know this story, you need to know it now, because it is happening again. Nelson Bunker Hunt and William Herbert Hunt spent the late 1970s accumulating physical silver and silver futures contracts. They were doing exactly what the smart money is doing in 2026. They saw the inflation, the dollar debasement, the money printing, and they bought silver. By January of 1980, They held approximately 120 million ounces of physical silver and controlled futures contracts representing another 50 million ounces. The price climbed from $6 to nearly $50 per ounce. And then the COMEX changed the rules. They did not just raise margin requirements, they implemented Silver Rule 7, which stated that no new long positions could be opened, not reduce leverage, not higher collateral. They banned buying entirely. The only orders permitted were liquidation orders, sell only. Silver crashed from $50 to $11 in 2 months. The Hunts lost over $1 billion and were eventually charged with market manipulation. The irony being that the exchange itself manipulated the market by changing the rules mid-game to protect the short side. That playbook is 45 years old. It has never been retired. March of 2020, the COVID liquidity crisis. When the pandemic hit and markets went into freefall, multiple brokerage platforms experienced conveniently timed outages at the exact moment volatility spiked. TD Ameritrade restricted certain option strategies. Charles Schwab went down platform-wide. Interactive brokers raised margin requirements on dozens of products overnight without warning, triggering mass forced liquidations. And the Federal Reserve, rather than allowing the market to find its natural floor, injected over $4 trillion in emergency liquidity through the repo market, the overnight lending facility where banks borrow money from the Fed using Treasury securities as collateral. Let me put that number in perspective for you. The entire market capitalization of silver, every ounce ever mined in human history at today's price of $70, is roughly $1.5 trillion. The Fed printed 2.7 times the total value of all silver on Earth in a matter of weeks to bail out institutions that were over-leveraged on the short side. That is the casino you are playing in. That is the system where the house does not just have an edge. The house can rewrite the rules, disconnect your terminal, and call it a technical difficulty. I expose these systemic brokerage halts and clearinghouse liquidity traps, so you are never caught frozen in a digital illusion when the real wealth transfer begins. If this early warning is helping you get ready for Monday, consider hitting the super thanks button below. Every dollar goes directly into the infrastructure that keeps this broadcast running uncensored. There are no corporate sponsors here, no ads for gold ETFs that store their metal in the same vaults being drained, no money from the people I am investigating. This operation runs on viewer support, and that super thanks button is the difference between me monitoring clearinghouse servers in real time on Monday morning and having to go dark. Now let me get into the actual plumbing of what is about to happen, because understanding this mechanism is the difference between being a victim and being a survivor. When you place a trade on your brokerage app, Robinhood, Schwab, Fidelity, E-Trade, Interactive Brokers, it does not matter. Your order does not go directly to the exchange. It routes through your broker, who then guarantees that trade to the clearinghouse. The clearinghouse, which for U.S. equities is the DTCC and for futures is the CME clearing, requires your broker to post collateral called margin to guarantee settlement. That margin requirement is not fixed. It shifts based on volatility, position size, market liquidity, and the discretion of the clearinghouse, which can raise requirements at any time for any reason with as little as 1 hour of notice. When they raise requirements, your broker has to post more collateral. If the collateral is not there, your broker has 2 options. Go to the repo market and borrow overnight, or restrict trading. Turn off the buy button. Freeze your account. Show you a message that says the system is experiencing heavy traffic. Please try again later. Here is the math that makes the clearinghouse's problem visible. With a paper leverage ratio of 7.4 times and registered silver at 88 million ounces, multiply those 2 numbers and you get 651.2 million ounces of paper exposure. At $70 per ounce, that is $45.584 billion in paper silver claims, backed by roughly $6.16 billion worth of physical metal. The gap between those two numbers is 39.4 billion. That is the hole. That is the liquidity deficit. That is the number being discussed in those emergency weekend war rooms right now. And that is the number that forces someone to pick up a phone on a Saturday and start coordinating the Monday lockout. Now, I know there are people listening to this thinking, come on, they would not actually coordinate simultaneous brokerage outages across multiple platforms. That sounds like conspiracy territory. And I have two words for you. January 2021. Robinhood, Interactive Brokers, TD Ameritrade, Webull, and half a dozen other platforms simultaneously restricted trading in GameStop and AMC on the same day, at the same time, citing the same reason. If that was not coordinated, it is the most extraordinary coincidence in the history of financial markets. And I do not believe in coincidences when tens of billions of dollars are on the line. Drop a comment below right now. Have you ever been locked out of your trading account during a major rally? Has your app ever gone down at the exact moment you needed to execute a trade? Or are you holding physical metal outside this entire system, in your own hands, in your own safe, completely free from the counterparty risk of a digital brokerage that can be switched off with a phone call? Tell me what your local coin shop is charging over spot for a silver eagle or a 10-ounce bar right now. That premium is not a dealer markup. That premium is the real market telling you that the paper price on the COMEX is a fiction, a holographic number on a screen that bears no resemblance to the actual cost of acquiring physical silver in the real world. Let me tell you exactly what to expect beginning at 9:30 a.m. Eastern on Monday, March 30th, 2026. Screenshot what I am about to say. Sunday evening around 6 p.m. Eastern, Asian markets open and silver futures begin trading on Globex. The Shanghai Gold Exchange, which has been trading silver at a consistent premium above the COMEX price for the past 18 months, a premium that at times exceeded $10 per ounce, will set the tone for everything that follows. If the Asian physical bid pushes silver above $75 in the Sunday night session, the algorithmic trading systems that account for over 70% of COMEX volume will begin adjusting. The gamma exposure from Friday's options expiration will carry over. The market makers who were squeezed on Friday are still short gamma going into Monday. They will need to buy futures to hedge. That buying will push the price higher. Higher price forces more buying. The doom loop resumes. Between 6 p.m. Sunday and 9:30 a.m. Monday, silver could move 5, 10, even 15% higher. By the time the American retail investor wakes up Monday morning, checks their phone, sees the price, and tries to log into their brokerage to buy, the price is already screaming. You will see a loading spinner that never resolves. You will see a message about unusually high traffic. You will see a banner saying certain securities have been placed in restricted status due to extreme volatility. Your portfolio value will update in real time, showing you the gains piling up, but you will not be able to execute a single trade. You will be locked in glass, watching. And while you sit there refreshing, the institutions will be trading. The market makers will be covering shorts. The bullion banks will be reclassifying eligible inventory to registered to create the illusion of adequate supply. The CME will be weighing an emergency margin hike, which they did in January of 2026 when silver was at $121, and which they will do again because it is the only lever they have left. I am going to say that word as many times as I need to until every person in this audience understands it, because it is the single most important concept in modern finance, and it will never be explained honestly on television. Rehypothecation is the practice of using the same asset as collateral for multiple simultaneous obligations. In the context of silver, it means the same bar, sitting in a COMEX vault, can be pledged as collateral by the vault operator, lent out by the custodian, used as backing for an ETF share, and counted as registered inventory, all at the same time. One bar, 4 claims. And when delivery time comes, when someone actually stands for physical delivery, The institution gets the bar. The retail investor gets a cash settlement and a letter explaining that delivery was not possible due to force majeure, which is a legal phrase that essentially means the system broke and nobody is responsible. This is why I say it in every video, every broadcast, every post, until I have no voice left. If it is on a screen, it is not real. If it lives in an app, it is not yours. If it requires a counterparty to honor a promise, that promise will be broken the moment it becomes expensive to keep. The only silver that is real is the silver you can put in your hand. The only wealth that cannot be frozen, rehypothecated, or force majeured away is wealth that exists in the physical world, beyond the reach of a clearinghouse that can change the rules on a Saturday afternoon. Let me put more numbers on the table. Gold is trading at approximately $4,493 per ounce as of Friday's close. The gold to silver ratio sits at roughly 64-1. Historically, that ratio has averaged between 40 and 60. During the January 2026 silver squeeze, when silver hit $121.67, the ratio compressed to around 45-1. At a 40-1 ratio, with gold at $4,493, silver would price at $112 per ounce. At the geological ratio of 16-1, which is the ratio of silver to gold in the Earth's crust, and which was the legal ratio under the U.S. bimetallic standard from 1792 until 1973, silver would price at $280.81 per ounce. 4,493 divided by 16 equals $280.81. That is the geological fair value of silver relative to gold at current gold prices, and right now you can buy it at $70. That is a 75% discount to fair value, and they are working this weekend to make sure you cannot buy more on Monday. Now let me bring in the global dimension of what is happening, because this is not a domestic story. The BRICS nations, Brazil, Russia, India, China, South Africa, and the expanding group of associate members that now includes Iran, Saudi Arabia, the UAE, Egypt, and Ethiopia, collectively represent over 40% of global GDP and more than half the world's population. They have been de-dollarizing at a pace that would have been considered impossible 5 years ago. The mBridge platform, the cross-border CBDC payment system that allows BRICS nations to settle trade in their own currencies without touching the SWIFT network or the US dollar, processed over $200 billion in transactions in 2025 alone. That is $200 billion of global trade that used to flow through American banks, used to generate demand for American Treasury securities, used to prop up the narrative that the US dollar was the indispensable reserve currency of the world. Now flowing through a parallel financial architecture that the United States does not control, cannot sanction, and cannot shut down. And what are these nations buying with their de-dollarized trade surpluses? Physical metal. The People's Bank of China has been buying gold for 15 consecutive months. That is not a trade. That is a strategic acquisition at a national scale. The United States is running a fiscal deficit exceeding $2 trillion per year. National debt has crossed $36 trillion. Interest payments on that debt now exceed the entire defense budget. The Treasury is issuing new bonds faster than the market can absorb them, which is why the repo market keeps seizing, because the primary dealers, the big banks that are supposed to buy Treasury bonds at auction, are running out of balance sheet capacity. They are stuffed with treasuries that nobody wants to hold, because nobody wants to lend money indefinitely to a government that is mathematically incapable of repaying its debt. Basel IV. This is the regulatory time bomb that mainstream financial media has almost entirely ignored. Basel IV is the latest iteration of international banking regulations governing how much capital banks must hold against their assets. Under Basel IV, physical gold held in bank vaults is classified as a Tier 1 asset, the highest quality capital for regulatory purposes, on par with Treasury securities and cash. This is a massive historic shift. For decades, Gold was classified as a Tier 3 asset, essentially junk. Now it is Tier 1, meaning every major bank on Earth has a regulatory incentive to hold physical gold on its balance sheet. The central banks that have been buying gold for the past 2 years are not just making investment decisions. They are making regulatory compliance decisions. They are front-running a rule change that makes gold the most sought-after reserve asset on the planet. And if gold is Tier 1, ask yourself what happens to silver when the supply deficit forces a repricing. Silver is not just a monetary metal. It is an essential industrial input for solar panels, AI infrastructure, defense systems, electric vehicles, and medical technology. Silver is civilization, and there are 88 million ounces of it left in the COMEX registered vaults, backing 7.4 times that amount in paper claims, with April 1st notice day 2 trading sessions away. This is exactly where we are. This is the Saturday before the Monday that changes everything. And I want to be absolutely clear about what I am saying. I am not giving you a price target. I am not telling you to buy or sell anything. I am telling you that the system that processes your trades, holds your digital wealth, and promises you free and fair access to the market is about to be deliberately turned off to protect institutions that are insolvent. And if your wealth is trapped inside that system when Monday opens, you are not an investor. You are a hostage. The velocity shock that is coming, the sudden violent repricing that occurs when a suppressed market breaks free of its paper chains, this is not theoretical. We already saw it in January when silver went from 40-something to 121.67 in a matter of weeks. That was the first V-shock, and it was barely contained through CME margin hikes, a coordinated paper short attack, and a Treasury Secretary going on television to blame Chinese speculators. They contained it at enormous cost, and now COMEX inventory is 31% lower than before that spike. The coverage ratio is in stress territory. Paper leverage is approaching 8-to-1. The Asian physical bid is building. The repo market is strained. The April delivery month is about to test every single assumption the system is built on. They will not be able to contain the next one. Not with margin hikes. Not with paper shorts. Not with narrative management. The only tool they have left is the lockout. Freeze the retail. Stop the bank run. Buy time. Cover the shorts. And hope that when they turn the system back on, enough retail investors are too scared or too demoralized to come back. Do not let them demoralize you. When your screen freezes, when the error code appears, when the restricted status banner shows up, that is not a technical failure. That is confirmation that you are on the right side of the trade and they need to stop you. This is what they have always done. From the Hunt brothers in 1980 to Robinhood in 2021, every single time the retail public has gotten close enough to expose the insolvency of the paper financial system, the rules change, the buy button disappears, and then they write the history books to make it look like the retail investor was the problem. Wall Street is building the cage this weekend. Monday is when they lock the door. They are running the exact same play they ran against GameStop, the exact same play they ran against the Hunts, the exact same play they run every single time history gives them the opportunity to transfer losses from institutions to retail investors and call it a coincidence. If it is on a screen, they can turn it off. The only question is whether you are watching from outside the cage or from inside it. Hold your mettle. Hold your ground.